Chasing Wisdom Podcast.
This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is Chasing Wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing Wisdom.
What up, what up, what up? My name is Rodney Lordston, and I am your host of Chasing Wisdom Podcast. So today's topic, we're going to talk about some real estate and how to make money. But let me get an intro correctly. This is Chasing Wisdom Podcast, where we talk everything financial literacy, credit repair, and Jesus Christ. So understand, I'm going to teach you how to make money in many, many ways. It don't matter what it is. I'm going to teach you about the money, and I'm going to put you on game, and I'm going to give you step-by-step processes. I'm going to break it down for you, and I'm going to make sure you get it, and we're going to go through it together. So without further ado, we're going to get into it. So today's topic is zero down real estate. This is the creative finance playbook for buying property without a bank. The creative mindset, the creative finance mindset. Why banks are optional. Understand what creative finance is and why it works, and how to shift your thinking away from the conventional loan dependency. All right, this is the conventional loan trap, and this is why most people never start. Most aspiring investors believe they need a 20% down payment, a 740 credit score, and 2 years of documented income before they can purchase a single property. This belief system is a single biggest barrier to entry in real estate. The conventional banking system was designed for homeowners, not wealth builders, and it rewards those who already have money. Creative financing flips this model by allowing you to negotiate directly with sellers, who often have far more flexibility than a bank would ever. When you understand that, the seller controls the terms as much as the price. You begin to see deals everywhere that most investors walk past. So understand, the bank is not your only option. Sellers are private lenders who just don't know yet. You know what I'm saying? They don't know yet, but they private lenders. Let's get into it. So there's 3 pillars of creative financing: the subject to, the seller finance, and the lease options. Creative financing is an umbrella term for a range of strategies that allow you to control or acquire property without using a traditional loan mortgage. The 3 most powerful pillars are acquire property without using a traditional loan mortgage, are subject to acquisitions, seller financing, and lease options. Each serve a different situation in seller type. Subject to means you take over a seller's existing mortgage payments while the loan stays in their name. No new loan origination required. So that's one way to do it. You just take over somebody else's mortgage, but the mortgage stays in their name. Now, the second way is no loan. I'm sorry, y'all. The second way is seller financing. This means the seller acts as the bank, accept monthly payments from you directly over an agreed term. So basically, this means you paying for the property over time, but instead of needing a loan or going through a bank, you go directly to the seller and make payments to them until it's paid off. Now, the last and final way is lease options. This gives you the right to purchase a property at a set price in the future while you control it and potentially rent it out today. Mastering all three of these gives you a toolkit flexible enough to handle almost any motivated seller situation. So you got the subject to, you got the seller financing, and you got the lease options. These are the three tools in the three ways that you're going to get into this real estate game without the bank. Learn them all and then choose one. So, subject to means you take over someone's existing mortgage. Seller financing is you paying it off to the owner or the seller. And the lease option is you get the right to purchase the property at a set price in the future while you control it right now. So you making money off the property, and in the future you're gonna buy it. You see? So now that we know ways to get in the door and get into this real estate game without the bank, without the loan, now we gotta figure out how we gonna find the motivated sellers, the cornerstone of every zero down deal. How we gonna find these people? Creative financing only works when you find sellers who are more motivated to solve a problem than they are to maximize their sales price. Motivated sellers fall into predictable categories. Probate hires who inherit property and want liquidity. Landlords burned out by problems, tenants, homeowner facing divorce or job relocation, and pre-foreclosed sellers desperate to protect their credit. Your job is not to chase every listing, but to identify people in these life circumstances who need solutions, not just offers. Direct mail, driving for dollars, probate court records, and building relationships with divorce attorneys and estate lawyers are all proven channels for reaching motivated sellers before they hit the MLS. The deeper your pipeline and motivated seller conversations, the more creative deals naturally emerge. So your deal flow determines on your deal quality. Build systems consistently to find motivated sellers. So you want to try to find people desperate to get the property off. Either somebody inherited this land or this building, this house, whatever, and they want the money instead of managing the property. So they want liquidity. You know what I'm saying? That's one version. Another version is a landlord who just tired of the tenants and tired of maintenance and all that. They gonna try to get rid of the property. That's another way. And the last way is to make connections with divorce lawyers and attorneys that's dealing with foreclosures and things like that. They can give you leads on properties that's going to before they hit the market. You know what I'm saying? They call it off market. So these are the properties that's going before it gets there. You want to get in and get the deal. Don't wait till it get there. Even though if it get there, there's still ways you can work it, but you want to try to catch it really before. Now, there's legal framework that you have to lay down to protect yourself in every creative deal. The creative financing is 100% legal when documented correctly, but cutting corners on paperwork can expose you to serious liability. Every creative deal must be memorialized in a written agreement that clearly defines the purchase price, interest rate, payment schedule, balloon payment date if applicable, and what happens in case of a default. For subject to deals, you should use a deed transfer, a performance deed out of trust, and a clear disclosure document that explains the transaction to the seller. Seller financing transactions require a promissory note and a mortgage or deed of trust recorded with the county. Always work with a real estate attorney familiar with creative transactions in your state, as laws around due on sale clauses, usury limits, and land contracts regulations vary significantly. Protecting the seller's interests legally is not just ethical, it builds reputation and keeps deals from falling apart. Every creative deal must be legally documented. Proper paperwork protects you, your seller, and your reputation. So make sure you got the paperwork to the T. Don't skip nothing. Don't cut no corner. Don't play. Make sure you paying attention to your paperwork and you making sure your paperwork is right. Make sure everything is displayed clearly in detail for the seller and for yourself. Because you don't want to be liable or get caught up. Now, we're going to master subject to acquisitions. How subject to actually works. The mechanics behind the strategy. In a subject to deal, you purchase a property by taking title via a deed transfer while the seller's existing mortgage loan remains in place in their name. You agree to make the monthly mortgage payments on their behalf, which protects their credit as long as you pay on time. The phrase subject to is the existing finance, meaning you are acquired to the property subject to the underneath whatever loan is already attached to it. This strategy is most powerful when the existing loan has favorable interest rate, low remaining balance, or terms that would be difficult to replicate in today's market. Because you are not originating a new loan, there is no bank qualification process, no points paid, no appraisal requirement, and no large down payment tied to a loan. Loan to value ratios. The seller benefits by avoiding foreclosure, reducing carrying costs, or solving a life circumstance, not necessarily by maximizing their equity payout. So subject to lets you inherit a favorable loan term that you could never qualify for in today's lending environment. So basically, you gonna get this property subject to after this loan paid off, basically. And what you gonna get is the terms they got when they first opened this mortgage may have better rates, better interest, and better terms than in today's market. So when you get this property subject to, you getting a better deal. And at the same time, you helping the seller because they may be in a bind and can't make the payments, or they may be ready to just offload. And so you're going to save them from foreclosure, and you're going to reduce the carrying costs and the burden on them, or you solving a life problem for them. Maybe they don't want the house, something bad happened, they lost family in the house, anything, divorce. So the subject to method is a way for you to get in the door without having the credit, down payment, or the money. You could just take over their existing loan. And when you take over the loan, As long as you making the payments on time, you helping them on their credit side and whatever the reason they want to get rid of the property. And at the same time, you getting better terms. So that's the first way to do it without the bank. Make sure you get the due on sale clause and understand the risk and managing it. The due on sale clause is a standard provision in most conventional mortgages that technically allows the lender to demand full repayment of the loan if the property is transferred without their consent. The clause is the primary risk in the subject to transaction, and understanding it clearly is essential before doing your first deal. In practice, lenders rarely invoke this clause as long as the loan is current, because a performing loan generates more value for the lender than a forced payoff. The risk increases if payments become delinquent, if you immediately flip or refinance the property, or if the lender receives a change of insurance notice and investigates. Mitigation strategies, including naming the seller's trust as the insured property on the borrower's homeowner's insurance policy, communicating with the seller to ensure they understand the arrangement, and having an exit strategy such as refinancing or sale ready within a defined time frame, educate investors managing this risk rather than avoid the strategy entirely. So you got to use mitigation strategies. These strategies are including naming the seller's trust as an insured party on the homeowner's insurance policy, communicating with sellers to ensure they understand the arrangement, and having an exit strategy such as a refinance or sale ready within defined time frame. So that's kind of like the wholesale deal too. That's part of it. The subject too. You can do it like that. So the due on sale risk is real but manageable. Performing loans rarely get called, and insurance management is your first line of defense. So that's what you got to do to mitigate that. You know what I'm saying? Get the seller information on the homeowner's insurance policy. Now, talking to sellers, scripts and conversations that actually work. The subject to conversation succeeds or fails because on your ability to lead with the seller's problem, not your investment strategy. Start every conversation with a deep discovery. Ask what the seller's ideal outcome looks like, what timeline they're working with, what their biggest concern is about staying in the property. Once you understand their pain point, you position the subject to solution as the answer to their problem rather than a unusual creative scheme. A powerful framing is, what if I could take over your payments and take the property off your plate completely? No commissions, no repairs, no waiting. You should be able to explain the deal in plain language in under 60 seconds without using any jargon. Role play your pitch weekly until the conversation feels natural, because sellers' confidence comes from your confidence, and hesitation in your voice signals doubt in their mind. So lead with listening in the seller's problem. Your solution only lands when they feel understood first. So go ahead and when you calling them and trying to get the lead, get the property, you need to figure out their pain point. So you need to ask them things they need and what's the problem with the property that they got to get rid of it, and you use that as leverage and put it in a position to position your offer. But don't go over 60 seconds. Don't use jargon. Be straight to the point, clear and clear. Now, structuring your first subject to deal, and this the step by step walkthrough. Before making any offer, gather the 4 critical numbers for every subject to deal: the current loan balance, the monthly payment including taxes and insurance, the remaining loan term, and the current market value of the property. From these numbers, calculate your equity position, your monthly cash flow if you rent the property, and your exit options such as refinance, wholesale, or long-term hold. A well-structured subject to deal typically has at least 10% equity at acquisition, a monthly rental rate that exceeds the mortgage payment by a minimum of $200 to $300, and a clear exit within 3 to 7 years. Draft a simple deal summary sheet that maps these numbers before you meet the seller, so you can make a confident, informed offer on the spot. After verbal agreement, move immediately to a written purchase agreement, a deed transfer with the company title, and a seller disclosure form signed before closing. So run your 4 numbers: balance, payment, term, and value before every offer so you can negotiate from a position of clarity. Now, that's the seller 2 method. Remember, we talking about buying property without the bank. Now, the second way to do this is called seller financing. Becoming the architect of your own deal. While sellers agree to finance, understanding their psychology, most sellers assume their only options are a cash sale or a buyer obtaining conventional financing, which means your job is to educate them on the third path that may actually serve their goals better. Sellers who hold mortgages often benefit from receiving consistent monthly income, potentially deferring a large capital gains tax event by spreading proceeds over time and earning interest on the money that would otherwise sit in a low yield savings account. Free and clear properties, those with no existing mortgage, are the most common candidates for seller finance because there is no lender complication. Older homeowners who have paid off their homes are looking for retirement income, often respond powerfully to the idea of becoming the bank and receiving monthly checks rather than a lump sum they don't know what to do with. Understanding these motivations let you tailor your pitch specifically to what the seller values most. So seller financing is the most powerful with free and clear properties. Find owners who have built full equity and need income, not a lump sum. So you're looking for the people who own the homes, who too old to maintenance the home or don't want to maintenance the home and ready to just sell and okay with taking payments instead of a big lump sum. So they looking for some retirement, income flowing in. Now, you got to negotiate the 4 pillars of a seller finance deal. Every seller financing negotiation comes down to 4 variables: purchase price, interest rate, authorization period, and a balloon payment date. Understanding how to trade across these 4 levers is what makes a skilled negotiator rather than someone who just makes one offer and hopes for a yes. If a seller wants full asking price, you might negotiate a lower interest rate or a longer authorization period to reduce your monthly payment. If they want a higher interest rate, you might push for a longer balloon term to give yourself more time to refinance or build equity before the lump sum is due. A common structure that works well for both parties is a 30-year amortization with a 5 to 7 year balloon, a below market interest rate, and a small down payment of 3 to 10%. That shows the seller good faith. Always model multiple deal scenarios side by side so you can present the seller with options rather than ultimatums, which dramatically increases the closing rate. So master the 4 levers: price, rate, authorization, and balloon, and you can structure a profitable deal from almost any starting point. Now, creating the seller finance package. Documents you need. A properly documented seller finance transaction requires 3 core documents: a purchase and sale agreement that defines the price and terms, a promissory note that outlines the loan repayment details, and a mortgage deed of trust that secures the lender's interest in the property and gets recorded at the county. The purchase and sale agreement should specifically that this is a seller finance transaction and refers to the promissory note as a financing instrument. The promissory note must include the principal amount, interest rate, payment schedule, due date, and what constitutes a default, along with the cure period. The deed of the trust or mortgage must be recorded immediately after closing so the seller lien's position is protected and public record confirms the transaction. Additionally, you should use a licensed title company or real estate attorney to close the transaction. Hold the deed in escrow if desired, and provide both parties with a HUD-1 or closing disclosure summarizing all financial transfers. Cutting corners on any of these documents can invalidate the deal or leave either party exposed. Always record your mortgage or deed of trust. An unrecorded lien is a unprotected lien, which puts both parties at risk. Now, let's get into the exit strategy for the seller finance. This how you profit on the back end. Entering a seller finance deal is just the beginning. Your exit strategy determines your ultimate return. The most common exits are refinancing into a controversial loan once you have built equity or improved your credit profile, selling the property outright and paying off the seller's finance note at closing, or wrapping the seller's finance by selling it to a new buyer on seller finance terms yourself while keeping the spread between what you owe and what they pay. This third option, called wraparound mortgage or WRAP, lets you profit from both interest rate difference and the price appreciation without refinancing. Before you enter into any seller finance deal, map out your exit, including the timeline, the minimum value needed to refinance, and the backup plan if the primary exit is delayed. Investors who plan exits before they enter deals make dramatically better decisions than those who figure it out later. So know your exit before you enter. Refinance, outright sale, or WRAP. Each produce different returns, so choose based on your goals. So what you gonna do? You gonna either refinance or you gonna just sell the property outright? Or you gonna wrap it? You know what I'm saying? Are you gonna wrap it? But that's up to you and what you think is the best exit. Which wrapping is just you selling it to a new buyer on seller finance terms. You know what I'm saying? Now, this is the third way to do this. Lease options in building your long-term creative financing business. Lease options explain control without ownership. A lease option, sometimes called a rent-to-own arrangement, is an agreement that gives you the exclusive right to purchase a property at a predetermined price during a specific period. Option period, while you simultaneously lease the property from the seller. This option fee typically 1 to 5% of the purchase price is a non-refundable payment that secures your exclusive right to buy and is often credited towards the purchase price at closing. During the option period, you can operate the property as a landlord by subleasing it to a tenant buyer who pays above market rent, with a portion of their monthly payment also credited towards their eventual purchase. This structure lets you profit from the difference between what you pay the seller and what your tenant buyer pays you, called a sandwich lease option spread. Without using a mortgage or making a large down payment, lease options are particularly powerful in high appreciation markets where locking in a purchase price today with the ability to buy in 2 or 3 years creates significant equity. Lease options let you profit from local control rather than ownership. The sandwich structure multiplies your returns on minimum capital. Now, this right here is my favorite one, and I'm going to tell you why at the end, but I'm going to keep giving you the game real quick so you can get this knowledge. You know what I'm saying? Because we chasing wisdom, and I got to give it to you. And once I'm done giving it to you, then I'm going to explain why I told you this one right here is the one I like. Now, building your deal flow systems and lead generation. Consistent creative deals flow requires a systematic lead generation option rather than a sporadic one off outreach. The most reliable channel for creative deals leads are direct mail to pre-foreclosure listings, expired listings, and probate records. Codes, SMS, and voicemail drops or absentee owner lists, community networking with divorce attorneys, estate attorneys, and financial planners who have clients needing real estate solutions, and social media content that educates sellers on creative options and positions you as the local expert. Track every lead in a simple CRM tool. Set follow-up reminders and recognize that most creative deals come from the 5th, 8th, or 12th follow-up rather than the first contact. Build a weekly rhythm that runs leads Monday and Tuesday, make calls Wednesday and Thursday, and go on appointments Friday. And review your pipeline every Sunday to ensure nothing falls through the cracks. Volume and conversations determine volume of deals. 10 conversations per week consistently will produce 1 to 2 deals per month within 90 days. Your pipeline is your business. 10 seller conversations per week consistently will produce 1 to 2 creative deals per month. Excuse me. I've been holding that burp for a minute. I had to get it out. I'm sorry, y'all. Building your power team. The people you can't succeed without. Creative real estate investing is a team sport, and your result will always be limited by the weakest link in your professional network. At minimum, you need a real estate attorney experienced in creative transactions to draft and review your documents, a title company willing to close non-conventional deals, an investor-friendly real estate agent who can comp properties and identify motivated listings, and a property manager if you plan to hold rentals. As you grow, add a CPA who understands real estate tax strategy and including depreciation, 1031 exchanges, and installment sale treatment of seller finance income. You also need a community of fellow creative finance investors who can co-wholesale deals, refer leads that they can't handle, and keep accountable to your goals. Finding your tribe through the local RIA meeting, online forums, and real estate education communities accelerates your learning curve by years because you learn from the others' mistakes instead of making all your own. So build your team before you need it. The right attorney, title company, agent, and CPA will save you more than they cost. Make sure you get that team in order, man, because that's how you're going to get to the big bag. You know what I'm saying? Scaling from your first deal to a full portfolio. The leap from creative deal to sustainable portfolio requires intentional reinvestment of time, money, and relationships rather than simply repeating your first deal in isolation. After closing your first deal, immediately systemize what worked. Document your lead source, your seller conversation, your deal structure, and your closing process so it can repeat and eventually delegate. Use your first deal cash flow to fund your marketing for the second, and your first deal's equity to support a refinance or sale that creates capital for a third. Experienced creative investors recycle equity through the BRRRR method. Stack seller finance deals to build a passive income based on and use profits to hire virtual assistants or part-time acquisition manager who handles lead calls so the investor can focus on relationships and negotiations. The investors who scale fastest treat their portfolio like a business from day one. They track KPIs, reinvest deliberately, and hire before they feel ready. So your first deal is proof of the concept. Systemize what worked and reinvest deliberately to build a repeatable portfolio building machine. You know what I'm saying? So copy and paste, baby. Copy and paste. If you want to throw that BRRRR in there, throw that BRRRR. You know what I'm saying? But okay. So now I'm going to tell you why I like the least two option the best. The reason why I said that's the best is because you can acquire the property without having to buy it all up front, and you can actually lease out this property. So if you smart and you buy the right property, now you're gonna have to throw in some money and fix it up a little bit or change it up a little bit. But I'm saying this because if you can find a property, whether it's a single family household or multi-unit property, preferably a single family resident with 4 or more rooms, you can take this property and you can rent each room out and make money per room, which will then help you make more money than the monthly cost you're paying to lease the property with the option to purchase later and take that money and make a profit. So you can start banking off this property before you even own it. And the seller's going to be happy because they already have their set term and they're banking as well. So now y'all both banking, and it's a way to do this through a company called SplitPad. So if you can get a nice property on a lease 2 deal, which is the one I told you is my favorite, what you can do is, if you need to change some walls and change some layout in the house, if you don't need to, you don't need to. Maybe the house is ready. And what you can do is you can just rent out each room. You know what I'm saying? I'm sorry for moving from the mic too much, but I like to move. But you can rent out each room, and when you do this, you're making cash flow from each room without even owning the property. That's why I say that's the best one. That's the best method. For your pipeline, if you need an assistant, I would refer you to Marblism. This is the best AI assistant software in the game to me right now. I'm going to leave the link below for you if you want to check that out. But I am King Rowe, and this is Chasing Wisdom Podcast. I'm going to leave y'all with that, and we're going to be out of here. I see y'all on the next video. Peace.
Yeah.
Chasing Wisdom
This is
Podcast.
Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan, kept my name on the line. This is chasing wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is chasing wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean, chasing wisdom.